Hey everyone, welcome to your Algo Lab. In today's session, you'll get a quick recap of this week's major economic releases and market movements, along with a look ahead at the key events coming up next week. Without further ado, let's get started. On Tuesday, the ISM Manufacturing Purchasing Managers Index, PMI, saw a slight increase, rising to 47.2 from 46.8 in July. However, demand-side factors remained largely weak, with new orders declining at a faster pace and export orders also contracting. On Wednesday, Australia's GDP grew by 0.2% from Q1 2024, matching its growth rate from the previous quarter. Year-over-year growth slowed to 1.0%, marking the weakest pace since 1991, aside from the early pandemic period. Per capita GDP declined by 0.4% from Q1 2024, continuing the per capita recession for a sixth consecutive quarter. Meanwhile, the Bank of Canada cut interest rates by a quarter percentage point for the third consecutive meeting and reaffirmed that further easing could be expected if inflation continues to decline. On Thursday, Eurostat reported a 0.1% year-on-year decline in the retail sales index for the Eurozone, underscoring the ongoing challenges for consumer spending across the region. In the United States, the ADP report revealed job losses in the professional and business services, manufacturing, and information sectors, while more than half of the employment gains in August came from the construction and education and health services sectors. Companies with 500 or more employees added the fewest jobs since the beginning of the year. The headline ISM Services Index held steady at 51.5 compared to 51.4 previously. While new orders improved and supplier deliveries slowed slightly, these gains offset declines in employment and business activity. On Friday, the euro area's economic growth for the second quarter was revised down to 0.2% quarter-on-quarter from the previously reported 0.3%. In Canada, total employment rose by 22,100 in August, slightly below the consensus estimate of 25,000. However, the headline employment gains overstate the strength of the labour market, as all of the new jobs were part-time positions. With the labour force growing faster than total employment, the unemployment rate rose to 6.6% from 6.4% in July. In the US, non-farm payrolls showed a net increase of 142,000 jobs compared to July's downwardly revised 89,000, but still fell short of the consensus estimate of 165,000. Additionally, June payrolls were revised down to 118,000 from the previous estimate of 206,000. Average hourly earnings rose by 0.4% in August, up from 0.2% in July and surpassing the consensus forecast of 0.3%. The mixed signals in August's job report may complicate Federal Reserve Chair Jerome Powell's efforts to persuade other Fed officials to support a significant rate cut in September. US stocks experienced their worst week since the peak of last year's regional bank crisis, ending a 3-week winning streak, as August's weak hiring data fueled concerns that the Federal Reserve's aggressive interest rate hikes are beginning to slow the previously resilient American economy. There is growing anxiety that the Fed's restrictive policies over the past 2 years aimed at curbing inflation are having a more pronounced impact on economic activity than anticipated. This has also reignited fears that the enthusiasm around artificial intelligence investments may have been overblown. On Friday, the S&P 500 index dropped 1.7% for the fourth consecutive session, marking its steepest weekly decline since March 2023. Losses were seen across 10 of the 11 industry groups, with technology and communication services leading the downturn, while the real estate sector remained unchanged. In Europe, the Stoxx Europe 600 fell 3.5% over the week, its largest decline since the regional banking crisis rattled markets in March 2023. The dollar showed mixed results, while gold and crude oil futures declined. Looking ahead to next week, US monthly CPI data is expected to show a 0.2% increase for August on Wednesday, with the core CPI likely to rise by the same amount. This would mark the fourth consecutive month of inflation readings, roughly in line with the Federal Reserve's 2% target based on PCE terms. On Thursday, the European Central Bank is anticipated to lower its refinancing rate by 25 basis points to 4% and its deposit rate by 25 basis points to 3.5%. Friday will bring the release of the preliminary University of Michigan Sentiment Survey. Lastly, let's turn to the Central Bank Watch. Here we review recent rate decisions and highlight what the market is currently predicting for future actions. Market is expecting for the rest of the year a total of 4.6 cuts or 1.15%, up from 4.0 cuts or 1.00% a week ago. On this channel, we share tested strategies for investing and trading, covering everything from technical analysis and fundamentals to economic trends and sentiment-based algorithms. If you don't want to miss out on any of our content, be sure to like, subscribe, and hit the bell icon to stay in the loop. Thanks for watching, and I'll see you in the next video.